A very warm welcome. You're watching Leaders of Tomorrow Season 10. I'm Ritvika Gupta. Tonight we'll be putting the spotlight on finance management, investments, and artificial intelligence, and much more. I'll be in conversation with two leading names in this sector. First up, we have Mrin Agarwal, Director Finsafe, co-founder Womantra, and in the second segment, I'll be speaking to Atannu Agarrwal, co-founder of Upside AI. Let's get started. I want to start by talking about the indices, which are like soaring high. What is your sense like? Is this party and celebration going to continue to the next calendar year, or are we going to see a market reversal?
Well, I think, we should always be prepared for course corrections after we've had an outlier year compared to the rest of the world. I don't know how it's going to really play out, if the recession is happening in the US or how things are really going to play out. I mean, we never thought that with all the global problems that we had this year, that India would still end up positive, right? So I think, from an investor's perspective, it's always important, to look at what could be the worst case and then plan accordingly.
Mrin, if you can also talk to us about the global and macroeconomic factors that will impact the overall indices. The G20 presidency means that India is on a global high. So what does it mean for the market?
Well, certainly we need to watch what's happening globally. So for example, what's happening on the US rate hikes and while the whole situation around supply constraints has become better, I think a bigger problem that I was reading about was on the wage inflation, which still continues to be high and continues to be an area of focus, right? And till the time that piece comes under control, I don't think that the rates are really going to start coming off. So I think from that perspective, we still need to be prepared for inflation much higher than what than what the regulators would like it to be. I think investors need to be prepared to see how they want to play their portfolios. Interest rates do not look as if they are going to come off substantially, right? So one needs to really see how you want to position your portfolio. So for example, if your portfolio is long-term in nature, then honestly you don't need to do anything much. But then if you have certain investments that you probably need in the next 1 to 2 years, you really need to think and check whether those are invested in the right way or not.
At this point, I also want to ask, how are retail investors looking at the market and the investment industry? And is it right to say that we have completely come out of the pandemic?
I do think that people are still quite cautious. From my sessions, we're getting a lot of questions regarding recession and how do we really play out in case of a recession. So I think people are a little cautious to that extent and are a little fearful in terms of how the markets would play out. So certainly I do see that sentiment at this point in time among retail investors.
Also, Mrin, do you feel that the impact that we are seeing now is similar to the 2008 sell-off, or is it better or worse? And also, what lessons have retail investors learned from the cryptocurrency unwinding?
So I don't think it's going to be as bad as 2008 because certainly we are looking at good growth prospects in India. Despite US inflation almost touching 9%, we did not see that our interest rates went up accordingly. So I think to that extent, our economy has been very well managed and continues to be so. And I don't really expect, what we saw in 2008 to really play out here, hopefully. In terms of investors learning from the cryptocurrency debacle, well, I certainly hope that they have, because we had been cautioning investors for a long time about the fact that you shouldn't invest in unregulated investments, and the very fact that you grow wealth over a period of time. There's nothing like, it's just your luck if you've been able to make a lot of money very quickly in a particular instrument, but that doesn't really happen across the board. And hence, you need to be careful of things that sound too good, which are just growing at a very, very fast pace. So I do hope that people have learned their lessons, that you cannot get rich quickly, you cannot make money quickly with investments. You need to give time to your investments, and more importantly, the fact that please only go in for regulated investments and do not touch anything that is not regulated.
We are also seeing a shift, as far as foreign investment is concerned. There's a larger shift towards India from China. Do you think Indian investors should currently focus on international investing?
If you truly believe only in the India story, of course, remain invested in India. But otherwise, you can look at some of the international markets, and specifically the US markets, which have come off quite a bit. I think one can slowly start allocating. The reason I say slowly is because the macroeconomic situation over there is still quite uncertain. We really don't know how things are going to play out the next year. So from a market perspective, I find investing in US markets a good choice at this point. But yes, as I said, spread it out in tranches. The second thing is that your holding really needs to be for a long-term period, because the environment over there, the macroeconomic environment, is very, very uncertain. So certainly do not look at investing 2 to 3 year money out there at this point in time. And the third thing is the mode of investing. So given all the additional tax compliance that exists with buying US stocks abroad, and the fact that for an investor to figure out what stock to buy and stuff like that is not exactly very easy, I think a very good option that exists today is buying it through the international mutual funds. There are a whole lot of funds that are available in this space targeting US markets, which can be considered, and these turn out to be more tax friendly in the sense, not only in terms of taxation but also in terms of the tax compliance.
Finally, even as we speak of adapting to the new normal of working, tell us, what sort of new investment tools, are we going to see in the coming year? How different will investing or saving look like in the new year?
The big focus on inflation, towards that, I think some easy low-cost investments that exist today are one, of course, the whole variety of mutual funds that are available both on the debt and the equity side. So for example, I think there are some very good target maturity funds that are available right now, where you can lock in for 4, 5, 10-year periods if you want to lock in for longer term on the interest rate side. I think there are some very, very good options that are available out there at this point. Secondly, on the equity side, of course, you have the entire index and ETF space. But again, I would say that if you have a long-term investment horizon, please invest in actively managed small cap funds. When you look at the performance of some of the funds, they have been generating alpha, beating the benchmarks on a regular and consistent basis. So certainly I would say take some allocation to actively managed small cap funds as well. But of course, you need to be in it for at least a 10 to 15 year period. Another product which I really like and I really recommend to all investors is the National Pension Scheme. The reason being that given the lifestyle expenses that we have and the way they keep increasing as we grow older, we need a product that is going to basically give us a good retirement corpus. So what I really like about NPS is that it makes people disciplined for the simple reason that you cannot pull out the money till the age of 60. So for most retail investors, this product is going to work because one, first of all, you do not need to figure out which fund to choose. Like, there's so many funds available. Sometimes investors do find it difficult to figure out which fund to go in for, large cap, mid cap, small cap. You choose the pension fund manager and you choose the investment choice based on the risk that you want to take. But more importantly, you are logged in for a long-term period. And of course, this is a very, very low cost investment as well. So all of these factors put together make it a great instrument to save for a large retirement corpus. I would say these are the three very simple, the target maturity funds, the whole equity mutual fund space that's there, especially the index, ETF, flexi cap, mid cap, and small cap funds that exist. And third, the NPS. These are three very simple products, low cost products that works for everybody.
Well, it was great chatting with you, Mrin. Thank you so much.
Thank you.
It's time for a quick break here. We'll be back shortly. Stay tuned. Welcome back. You're watching Leaders of Tomorrow Season 10, and right now I'll be in conversation with Atannu Agarrwal, co-founder Upside AI. Take a look. Thank you so much, Atannu, for joining us today on Leaders of Tomorrow.
Thank you for having me. Very happy to be here.
So, as I was prepping for this interview, I came across your website and I came across something really interesting that was written. In the long run, technology is going to end up making better investing decisions than humans. And I thought that was very interesting, dystopian, but also a reality. So I would like you to elaborate on this thought and also tell us the fundamentals that went behind setting up Upside AI.
Yeah, I mean, it's pretty much that, right? We believe that in the long run, if I was to state it very simply, that machines or technology will be a better fund manager than human beings. Right? And again, this is not an idea that's unique to us that I thought of in my dreams, but it's something that I've learned over the course of my career. Specifically, having spent a lot of time in New York, I spent most of my career in New York. And what's happened there, right? If you look at the US or even if you look at other developed markets like China or Europe, etc., is a lot of money. It's either in passives, right, where people are doing ETFs or stuff like that, which is of course a very massive market now, or on the active side, it's mainly with quant funds, right? If you look at the biggest hedge funds in the world, if you look at the most successful investor of all time, which is kind of an inspiration for us, is a fund called Renaissance Technologies, right? It's a fund run by Jim Simmons, who's a scientist, mathematician who started it. And he, the whole thesis of the fund is, actually no one really knows what they exactly do because they don't reveal it, but they're basically a quant fund, right? They use quantitative methods to invest. And I think that will happen in India as well. It'll maybe happen over a period of time. I think we are still very early in our investment journey in terms of both the maturity of our markets, our investors. Generally equity is a very small part of everyone's portfolio today. Sure. But in the next 10, 15 years, as you get better data on Indian companies, on the markets, as investors mature, as the market matures, I believe that quant will only grow as an investment class. And by quant, I mean generally technology, using technology in investing will grow as an asset class, right, over time, right? Even within quant, I would say a lot of people today rely on manual methods, right? If they're doing factor investing, so they'll rely on Excel sheets and stuff like that. I think that will also get more and more sophisticated, right? For example, like at Upside, we use machine learning algorithms and combine that with fundamentals, right? I think that will happen more and more as we go along. Today, there are only a handful of us trying to do that. But as I said, over the next 10 years, you'll see more funds doing it.
Interesting. So just before the chat, you were just telling me that it's been like 3-4 years, since you started. So give us an overview of how the journey has been, some of your key milestones, with a special focus on your funding journey as well. And the third part, some of the key challenges that you have faced as a company.
Yeah. So, the three of us who started it, me, Kanika, Nikhil, none of us come from the Indian public market space, right? We are middle class kids who decided to go on this journey. My experience is mainly in the US. Kanika is on the venture side in India. Nikhil is purely a technologist. He's a PhD in machine learning. So none of us come from this world, right? So when we started out, it was daunting because getting the license, getting a PMS license itself is difficult, right? But we managed to do that. Then beyond that, building trust in the system, right? Because ultimately, the asset management business, the wealth management business is a trust business. Right? There are massive brands who have most of the AUM, right? Whether it's HDFC, Kotak, etc., who have most of the AUM. And there are, fund managers who have spent 30, 40 years doing this, right? Saurabh Mukherjee or Sunil Singhania. These people have been around for a long time, so they have a lot of trust in the system. So we are new kids on the block. One is that. Second is we're trying to do something unique for India, right? We're not doing the same thing everyone else is doing. We're not really doing fundamentals investing. We're not doing technicals, which is also another sort of space popular in India. We're doing something which is a mix, right? Which is we're using machine learning. We are combining that with fundamental investing, which people haven't really heard of before. Plus, we didn't have the connection. So it took us a long time to get there, right? And a long time to meet people in the system, get them to see us for what we are, get them to trust that we are actually doing what we are saying we're doing, right? That takes a lot of time. And it's been a fruitful journey, right? We've got now pretty established in the industry in our own little way, right? We have a bunch of distributors who are our partners today. We have pretty big family offices who have trusted us with their capital. Small capital, but they've trusted us with their capital. I'm sure they'll grow over time. And from a funding perspective, we were very fortunate to get some very marquee shareholders on our as shareholders in our company. And we had NDA Partners, which is a venture capital fund based out of Hyderabad. They especially focus a lot on deep tech startups, and that's why we were someone they considered, and they led the round in Upside last year. And then we had Vijay Kedia, who's of course a very well-known name in the public market space, and he sort of liked mainly our attitude, and he, as he in his own words likes the hunger that we have to build something. So I think he also came in as a shareholder, and so did Ajay Nanavati, who's the ex-head of 3M in India, chairman of Quantum Mutual Fund, and Gopi Katragadda, who used to be the CTO of Tata Sons, right, and now runs his own AI company. So he's also a shareholder. So we got a couple of people from the market side, a couple of people from the technology side to come in and sort of validate what we're doing, right? And that's really helped us immensely, because starting out as just the three of us, today we've been able to build out a team. We're a team of about 10 people across 2 offices. We've been able to spend more money on sales and marketing and getting our name out there, which has helped immensely. So that's been our journey.
Wonderful. On that note, tell us what, according to you, is Upside AI's biggest USP? What differentiates you from other competitors, portfolio managers, etc.?
Right. So I would say that Upside's USP, or I would put it more like Upside's sort of positioning in the market stands on 3 pillars, right? The first pillar is that we believe in systemized investing, right? We believe that a rules-based approach or a systemized approach will stand you in better stead over the long term, because it eliminates the fund manager's bias, right? It eliminates any bias I would have or my co-founders would have in managing capital. It eliminates that. We rely on a set of rules that we've established. We rely on the machine, so it's able to invest consistently with discipline over the long term without any of these hindrances, right? So I think that is the number one pillar, that we believe in a systemized approach. The second pillar is that we, as I told you, we use fundamentals, right? So across our products, we rely on either macro fundamentals like GDP, inflation data, or company fundamentals like P&L, balance sheet, cash flow, right? Yeah. We don't use any technical factors, right? So, and the reason why that's a differentiation is because a lot of funds that use technology or use quantitative methods tend to actually use a lot of technical factors. They look at price action and stuff like that. We don't do any of that, right? We are not a high frequency shop. We are a low frequency shop. The most we trade is once a quarter, right? So we are a sort of a combination of 2 things, right? We are on the fundamental side in terms of our frequency, but also we are relying on technology and machine learning for the products, right? So that's sort of the second point. And the third point is that we're dynamic, right? What happens a lot on the fundamental side is that people build portfolios, right? And that those portfolios stay the same for a long period of time. And I think that's a very good approach. I think if humans are investing, that's the right way to do it. But because we are using a machine, and because the machine is able to parse data at a much faster rate than human beings, the machine is able to optimize and build portfolios that are conducive to those market conditions, right? That is the main sort of power of using a machine, right? It's able to take in all of this data, there's so much data out there, right, today. And it's able to make sense of it and say, okay, in these market conditions, this type of a portfolio makes sense, right? And change that every so often. I told you that we trade once a quarter, so sort of adjust that portfolio every quarter, right? So that's those are our three pillars, that we are dynamic, we rely on fundamentals, and we are we follow a very systemized approach that we stick to, right? So those are I would say our three pillars.
Right. Finally, as you wrap up this conversation, we are stepping into 2023.
Yeah.
Tell us, what is your outlook for the company in 2023, and what are the kind of products that you are bullish about, if you can talk about that?
Yeah, I mean, since we are in the markets, and a large part of our growth is tied to the markets, right? We've probably grown 10x, 15x in the last couple of years, right? But that's also benefited from the fact that the markets itself have performed really well.
Mm-hmm.
So, if the markets don't do well for any reason, and there can be many reasons for that, right? And no one can predict that. I know lots of people claim that they know where the markets are going. I claim to be an expert, but I know that I don't know where the markets are going to go. So a large part of Upside's short-term journey will always be tied to the markets. And for me, that is why Upside is a 15-20 year journey, right? Where there will be years in which we might not grow like we have grown in the last couple of years, and that's fine. And that's why I don't try and predict what will happen in 2023, because it's not a business where I'm just selling a product to a customer and it depends on how I interact with the customer. Here there's a huge big factor, which is the markets, which affects what my growth looks like, right? So it's very hard for me to predict what 2023 will be, but as I told you, it's a long 15-20 year journey, and we have a bunch of products that we are really excited about, right? Of course we have a traditional equity product that's been our longest running product, but now we have a product that we've built for turbulent markets, right, which is doing very well. It's called Upside Navigator, which basically allocates, it's a hybrid product that allocates between asset classes, equity, debt and gold. Mm-hmm. And its main USP is that when markets are turbulent, it does really well. So for example, this year, of course the markets have recovered now in the second half of the year, but in June, when they were down almost 15% at one point, this product was essentially flat. It was down like 2%, right? So it really is meant for markets like this, and I'm really excited about it, that even if we do see turbulent times, and maybe because of that our growth in equity products is lower, hopefully products like Navigator, which is a hybrid product built for turbulent markets, will come into its own, and we'll see some growth there. So that's where we are at.
Well, all the very best. It was lovely chatting with you.
Thank you. Thank you so much for having me.
With that, it's a wrap on this episode of Leaders of Tomorrow. We hope you enjoyed the conversations. Thank you and goodbye.